Jesus.
S&P 500 program trade buy level 1.
It's your wake-up call, pal. Go to work.
Okay, before we get started, a little bit of housekeeping. I'm recording this one as both a podcast and a video. If you're in the podcast camp, I will be referring to screenshots here in the video. I'll be putting those on my podcast site, bowerpost.com. Just go there, find this podcast, and you'll see the pretty pictures beneath the podcast thingy. All right, let's get on with it. So today we're going to look at trading crude oil. Well, not exactly. We're going to look at some strategies around trading, and we're going to use crude oil as an example because it's a great market to look at these kind of strategies. We're going to have a look at, first up, we're going to have a look at trading futures in crude oil versus trading CFDs in crude oil. And then we're going to have a look at a very simple futures spread. If you've never heard of futures spreads before, that's cool. We'll go into that. And we're going to have a look at a complex futures spread, a scary, scary complex futures spread. Not really. It's actually going to be a heck of a lot simpler than you think. And I'll show you why. And we're going to look at the risk of trading these kind of spreads, and we're going to look at the consistency, essentially the why do it kind of thing. So we'll look at that a little later on. First up, let's have a look at CFDs. I'm not going to spend a lot of time here because I don't trade them and don't like them. Essentially, a CFD is an over-the-counter product, an OTC product as they call it, which means when you're trading a CFD, you're trading directly with a broker. They issue the product, they make the market, they make the prices in the product. And here's a snapshot that I picked up from a CFD website just this morning. This shows crude oil, their product crude oil. Essentially all you can do with a crude oil CFD is buy it or sell it. There's no complexity, there's no depth of strategies you can implement. You can buy it, sell it, or you can do nothing. And in this particular instance, it shows, which I think is a little bit misleading, it shows a chart that says crude oil futures chart, which kind of to me implies that you're trading futures, but you're not. When you have a CFD account, you're trading a CFD. In this instance, it would be a CFD on futures, not an actual futures account. So as I said, a CFD is an over-the-counter, a broker-issued product. They issue the product. They guarantee the product. They make the market. They make the prices. They call the shots, essentially. So you can see here, check it out. They've got the buy price and the sell price on the left here, which is 9 cents apart. Normally in crude oil futures, you're 1 cent apart. So when they say you don't pay commission, yeah, you do. There it is right there. 9 times the price of what you pay in futures. Futures are a little different because the commissions are cleanly disclosed. You pay a dollar or a cent price per contract. So it's a little bit more transparent there. But what you also get, pardon me, with CFDs is there's just one price for crude oil, whereas let's have a look at futures. Here, this is a table that I just took a snapshot from the CME, Chicago Mercantile Exchange, cmegroup.com. Took that snapshot from their website this morning, and it shows some of the futures prices available for crude oil. Now, crude oil has monthly expiries, which means there's a price for, it's now November, there's a price for December, there's a price for crude in January, there's a price for crude in February, March, April, May, and so on and so on and so on. I think it goes out 10 or 15 years or something like that. But the guts of the trading all occurs within the first 6, 8, 9 months, something like that. But what that does, and why this is important, because it means we can take a wider range of clever and well-researched strategies, more than just your regular buy and sells. It means we can take different risks. We can take lower risks than just a regular buy or regular sell, or regular short, I should say. It means with less risk, you can go ahead and invest less. It means you can hold trades longer. If you've ever been in a trade where you've entered the market, you put your stop in, you've seen the market, bang, 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 hit your stop, and then take off in the direction you intended it to. If you've ever had that feeling of disillusionment or pissed offedness, you're not alone. That happens. But with spreads, you can work out strategies where the strategy is a little bit more forgiving because of the changing in the nature of the risk. And I'll show you a couple of those strategies in a second. So before we get into examples, I just want to cover off what a spread is. Okay, so you may have heard of the term from a buy-sell spread point of view. That means the difference between the buy price and the sell price. Back there, let's go have a look at that CFD again. The buy-sell spread here is about 9 cents. Okay, that's not what we're talking about here when we talk about spreads. We're talking about, when we talk future spreads, we're talking about the price difference between one contract and one or more other contracts. So you've got a list here, we've got a list here December through to September of crude oil prices for each of them. A spread is the difference, a spread price is the difference between any one of those two, for example. So the goal of spread trading is to essentially profit from the change in the price differential, not the change in crude oil overall. And it's also, goal of spread trading is to offer you different risks. Again, we'll get into that. So here's an example of a spread trade. You can see I've got some pretty colored arrows marked next to May and June, and the chart there shows the spread price, the spread differential between the May and June contracts. There's terms now in futures, bull spread and bear spread. A bull spread is when you are buying the near contract and selling the far, and a bear spread, believe it or not, is when you sell the near contract and buy the far. In this example, I'm going to have a look at the May versus June spread. May is trading at the moment $39.35, and June is trading about 30 cents above that. The spread price, therefore, is May minus June, which will be minus 32 cents. Okay, that's about where the market is for that spread. So just like you can buy futures and hope they go up, or go short futures and hope they go down, you can buy the spread or sell the spread with a view of that spread price differential changing. So a bull spread means when you're buying near, selling far. Bear spread, selling near, buying far. Kind of makes sense because in most instances the spread price would be somewhat correlated to the underlying price. That is, if we see crude oil go up, we'll see the price differential also go up. Okay, in fact, this is a great example. You can see in this table here, the previous trading session, May futures lost $1.17 in that particular day, and you can see that the spread price also lost money. But there's a difference in risk too. You can say, okay, so $1.17 in the futures is worth $1,170 per single contract. Here in the spread, it looks like we've gone from about 29 cents to down to neg 32, neg 30, neg 32. So it's only lost a couple of cents. So it has that lower volatility. Okay. So that gives you, as I said, that gives you a more scope to either risk less, trade more, spread your trades over different spreads, that kind of thing. In fact, let's take a look at that risk, in not just looking at the end of day prices there. But so here I have a chart of May crude and June crude. I use the average true range, the ATR, to measure risk and volatility. It's an indicator that's available on pretty much every single charting package out there. It essentially shows you the average range for a particular session, and we're looking at daily charts here, so it's the average trade range for a day. Currently, the May contract is $1.59 average true range, and the June is $1.61, pretty much the same. Now, in dollar points, in dollar values, I should say, that is about $1,600 for each of them. So that tells you how volatile the contract is, how you could say how much you expect out of the market on any particular day in terms of volatility, about $1,600 in volatility. Compare that to that spread price. Here we have a chart of the spread. The average true range is 5 cents, not $1.60, but 5 cents, 1/32 of the amount. So that's about $50 a day. So current volatility for that spread is $50 a day. Now, as implied by that spread, that ATR chart, it does change. And particularly as you get closer to expiration, things can get a little bit more volatile in something like crude oil or other spread markets. But right now, as it stands, $50 a day risk versus $1,600 a day risk, quite different. So that's one of the attractive features for a lot of people learning to trade spreads. They say, well, I don't have to risk as much when I do this. And for the most part, that's right. Look, there are always extreme circumstances, but that, if there's an extreme circumstance in a spread, that tends to be the same in the underlying market too. Okay, so you don't wake up one day and May's gone up $6 and June's gone down 10. That tends not to happen. Things like that can happen in theory, and we saw some craziness most recently when the price of crude went negative right on expiry day. But for the most part, those things are so rare in happening, and with some sound education and risk management principles, it won't happen to your account either. So what I've done with this spread, I want to go a little bit deeper into this May-June spread and show you some of the research we can do, and therefore look at this trade as a more viable thing. As I said, with CFDs, you can buy it if you think it's going up, sell it if you think it's going down. We can dig deeper with spreads and get some more consistent research, consistent numbers to give us a bit more confidence in taking a trade. So here, what I've got, this chart on the right shows the little black line there is our spread price, trading about neg 30. You can see that there, 30 cents. And the red and the blue lines are the exciting ones. Really interesting way to look at things. This takes that same spread, which is May versus June, and it takes the average for how that spread has performed over 5 years and 15 years. All right, so what it's done is, say, for the 5-year one, it's taken the May-June contract from last year and the 4 years before that, made an average and shown you how that spread has behaved from now up until, May next year. Now it's done the same for the 15 years as well. And what I like about this is that there's a clear and defined trend, and there's some clear consistency here. In fact, I've gone ahead and optimized some trades here and searched for some trades here, and you can see where I've put the red line and where I've put the green, or the red arrow and put the green arrow. And if we were to, in theory, sell around this point and buy around this point, sell at the red and buy at the green, the last 5 years, that has been correct 5 out of 5 times, 100% strike rate, and made about 38 cents. $380 per contract. Now remember, this is a spread that currently has risk of about 5 cents or $50 a day. So that's a pretty good, not only is it a perfect strike rate, it's a pretty good risk reward rate as well. Over the last 10 years, you're looking at around the same profit, and only 1 year, 1 loser, 9 winners, 9 out of 10 times. The last 15 years, 13 out of 15, which is 87%. It's made a bit more over the last 15 years at 470. So again, that's a fantastic strike rate when looking at those averages, when digging deeper into that seasonal data, as they call it, digging deeper into that historical data, and looking at that volatility as well. You've got a great looking risk reward, but you've also got a terrific strike rate as well. Now, as always, the past does not equal the future. Next year, it could be the first loser in 6 years, for sure, absolutely. But we can't really read the future. We can't analyze the future as much as we can the past. So we have to go off the past to give us a degree of reasonable patterns. You have to say that that's pretty consistent. So it can be quite good data to essentially build a strategy around. So let's have a look at another spread. Now I said we were going to have a look at complex spreads, right? Now, the whole idea of a condor, if you are an options trader or have traded options, you'd know what I'm talking about when it comes to condors and butterflies. Essentially, those two strategies are two spreads combined. So it's the same thing with futures. There are some similarities, there are some differences with options and futures. We won't get into options now, but in this example, I'll show you an example of a condor. So in the last trade, we looked at May versus June, right? We looked at May versus June, as in selling May, buying June. It's a nice looking bear spread. Let me go back to the chart there. It's a nice looking bear spread that's been profitable, 13 out of 15 years, blah, 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 right? Let's add an extra spread to that to create a condor. Now, to do that, it's essentially, a condor is a combination of a bear spread and a bull spread. You can see where I've marked the red and green arrows here, which shows you the position we would be trading. In this instance, we take our bear spread May, June, and we'd add a bull spread in July, August. Okay, so being short May, long June, long July, short August. If that's confusing, it is at first. As I said though, the maths behind spread trading is no more complex than pluses and minuses, but occasionally you go, yeah, but a little bit of practice gets you over the line with that one. It's not that complex. But I've gone ahead and done the background stats for this condor spread as I did the bear spread, and it's kind of interesting. I'll show you some interesting stats here. So you can see here's this black line here shows the current condor spread, the value of that spread price. Just like you can in the underlying contracts, you can buy this condor or sell this condor, okay, and hope to profit from the change in the net prices of those 4 contracts. Now, what generally happens when you add more futures contracts, you may think it gets more complex, but it also gets less risky. You also start hedging out. You also start offsetting your risk in trades. Just like, let's say we were going short May just by itself. We've already established that our risk in terms of average true range is about $1,600 a day. If we were to add the long June contract to creating a bear spread, we still have a bearish outlook on the market, but we've cut back our risk by a factor of 1 on 32. 1 on 32, remember we looked at a $1,600 risk in the outright and a $50 a day risk in the spread. Okay, so that spread itself cuts out a lot of risk. Now, what do you think you do if you have a bear spread and then add a bull spread behind it? Well, that cuts out your risk even more. Okay, so these type of trades tend not to be the type of things scalpers do. It tend to be more get in at the right price, sit and hold and wait for the spread to start doing its thing. Now, this is really interesting, I think, because you can see this chart, which again shows the current value of the spread, in this case the condor, but it also shows the historical pattern over the last 5 and 15 years for that spread, how it's behaved last year and backwards and backwards, backwards. Okay, so what's really interesting here, check this out. The last 5 years, strike rate has been 100%. Last 10 years, 100%. Last 15 years, 100% strike. 15 years, 15 trades, and they've been profitable each time. This assumes that you're buying with a little green arrow is buying now and selling around this time in the early of next year, early parts of next year. Okay, so you can also see what's interesting here when we talk about risk. Okay, so let's go back here. We're looking at risk here, or potential reward or historical performance of this particular strategy of around, say, $400 for the bear spread. If we look at the same data for the condor, it's about half that. Funny that, hey, half that. You add an extra spread and you halve your potential, but you increase your strike rate. That's kind of interesting, I think. So again, this type of strategy, while you think at first, oh butterflies, condors, they're way too complex, all they're essentially doing is cutting down on your risk and allowing you to either trade more, trade a wider range of different strategies, or just trade with a smaller account. You know, dip your toe in the water if you like. These aren't necessarily the spreads you should be trading if you've never traded before, but there's certainly something that I think I've demonstrated here that it's worth learning about, because we can get that consistency and we can get that more controllable risk than trading outrights. Let me sum up here. I've been rambling on for a little bit now, but let me sum up. We covered futures versus CFDs. CFDs are very binary. It's either up or down. Futures can be binary too. You can just buy a futures contract, sell a futures contract. But once you start getting into the more deeper styles of strategies, essentially futures spreads, you can find that you can start tailoring what you want to risk. You can start defining your consistency of research a whole lot better. Right, so we looked at those simple futures spreads, the bull and bears, and then we said, right, well, if we put those two together, we have a thing called a condor. We've got another video here around somewhere talking about butterflies. There's a podcast there on butterflies as well. So that's a similar thing to a condor. The only difference is what expiries you select. Okay. So all in all, a lot of this stuff is covered in my Advanced Spread Trading course on masterclasstrader.com. We go into a whole lot of deeper things in the course too. Things like how we go about getting fills, how we build these spreads, why we build these spreads. We dig deeper into the research tools, how we go about getting in and out of the market, and particularly managing risk, managing your portfolio risk, that type of stuff. That's all covered in the Advanced Spread Trading course. But I do want to get across the point that it's not advanced in terms of the complexity. It's just advanced in the terms of your knowledge, taking your knowledge forward and saying, right, well, I've been disillusioned with that whole idea of going long, seeing the market hit my stop, and then only see it again, turn around and keep going up. If you've had that happen to you, then it might be time to start looking at some more deeper strategies that we cover in the Advanced Spread Trading course. If you go to masterclasstrader.com, there should be a link along the top that says specials, and that'll get you, currently there's a special there for 20% off or 40% off depending on what package you buy. So it's a pretty good deal. Check that out, masterclasstrader.com, and click on the specials link. And that's about it for now. Happy trading and good luck out there.
You've reached the end of another episode of the Trading with GB podcast. Thanks for listening, and see you at the next episode.